Hi, how are you doing today? My name's Megan. It's really nice to meet you. Oh, peace signs, that's right, no handshakes anymore. So I just wanted to welcome you into our office today. I'm glad to hear that your day is going well. Mine's going well as well. Happy Friday, you know how it is. So for today, I have you scheduled for a 3 o'clock personal finance session. So I have us here slotted for about 20 minutes just to iron out some of your personal finance preferences and get you started on some sort of investment plan for today. So I've run a little bit of analysis to kind of figure out where I think we should place you, just based on your age and your risk tolerances. But I do want to have a conversation with you just to see where your head is at as well. So let me go ahead and pull up your file here. Okay, so based on your age, I think that your portfolio could lean a little bit riskier. I know that you don't have a super high risk tolerance, is that correct? Okay, so, and that's completely fine. So we can definitely work with that and get you a portfolio that you're very happy with. But generally, the recommendation for someone your age is you want to lean about 70% equity, 30% debt, with, you know, we have a little bit of room. I would say about 5% for cash, kind of more liquid investments. And remind me again, what was your amount that you wanted to start investing with today? Okay, and then, so what is your income every month after tax? Okay, so I would say generally I would recommend, if you can, to invest about 10 to 15% of your income in different ways. So that would include your retirement plans, and that would also include the investments that we're going to talk about today. So today I'm not going to touch on any of the retirement plans because those are things that are, I can hit on them a little bit, but generally you should be covered under a 401k in your current job, correct? Because you're a W-2 employee and you work at a semi-large company. Okay, perfect. So that is part of that 10 to 15% rough ballpark number. And then in addition to that, I'm going to make some recommendations today for what I would like to see in this portfolio. So I'm just going to take some notes here just to make sure I'm capturing everything. Okay, great. So then it looks like, so 15% of your monthly income would be about this amount, correct? Let me show you what I have here. Okay, great. So looking at that, if we want to go 70% equity, so let me kind of just explain a little bit what that is, because I know it's kind of like not a very clear term. So equity is when you own something in a company. Generally, when somebody is talking about equity, they mean stocks. So publicly traded stocks on the New York Stock Exchange or S&P. There are various ways that we can invest for you, but generally the equity is more risky because it just ebbs and flows based on the supply and demand of the stock market. So it is a little bit riskier as opposed to the other option, which is our fixed income options, which would be bonds. So bonds are less risky if you pick highly rated ones. The highly rated bonds are safer investments because you have a higher guarantee of getting your money back, because with a bond it's essentially a loan where you're lending your money to a borrower, and in exchange for that they pay you interest, and then at the end of the term they repay you what you originally loaned. So you're basically making interest on it. Now you can choose whether you want to invest in safer fixed income options, which would have a lower interest rate, or you can pick the more risky bonds, which would have a higher interest rate in exchange for the fact that they have worse credit and may not pay you back. So there's kind of that trade-off, the risk-reward trade-off when it comes to both equity and bond options. But because you are still very young and you have approximately 35 years until retirement, you have plenty of time to ride the waves of the stock market. And generally over time, stocks trend in an upwards direction, especially over the long term, like a 30-year period. So that's why we strongly would recommend that you invest a high majority of your monthly income into the stock market, with some balancing out of bonds and some other ETFs, which are electronically traded funds, and the ETFs are automatically diversified because they are invested in multiple funds. So I personally like ETFs. You will pay a fee because somebody is managing it, but the benefit of the ETF is that it is diversified. So for example, if you wanted to invest in a technology ETF, you might get to own some Google, Facebook, Amazon stock indirectly through your ownership of that fund, as opposed to just outright buying the stock. And for example, the Amazon stock is rather expensive to buy one share. So personally, I like to put it into an ETF. Let me see where we are at today. So, one of my favorite ETFs is the information technology ETF. So today, let's see. Today, the shares are trading for $415.99 a piece. So let me just pull up my investment spreadsheet for you so we can start ironing out some of these numbers. Okay, so if we purchase 20 shares of the information technology ETF today, that would be a total of $8,319.80. This ETF has shown, let's see, show me the rate of return, but I can tell you that over time, so over 3 years, it has trended in an upwards direction with, just a couple of drop-offs when the market has tanked, but it always recovers very well. And it pays annual dividends of about $2.92 a share, has a gross expense ratio of 10.1%. But it is definitely a good buy. So would you like to move forward with that one today? I think that this is probably a great investment, and we will probably continue to buy shares in this fund just because of how well it performs, and the good outlook on it. beautiful. So one of my favorite stocks, well, I actually very much like the Spotify stock. This one has been very successful over the last few years. You know, obviously past performance is not an indicator of future performance. However, I think that we should put some money into this one. So currently, Spotify is trading at a price of $173.88. So I think for this one, I will just recommend 10 shares, and that would put us at $1,738.80 for 10 shares of Spotify. Now at this point, I want to diversify us a little bit because we are getting into a lot of technology stocks. So I'm going to direct us towards, let's see, a travel stock. I think that a good buy at this point in time is going to be Alaska Air Group, which is Alaska Airlines. So this one hasn't been doing so well lately because of COVID. So what I would like to say is that it is on sale right now for $53.49 a share, and it's sure to increase over the coming months because it is at a discount right now just because of everything that's going on in the world. So this will diversify us a little bit more into the travel sector. So at $53.49 a share, let's see, I would probably recommend, let's get with 25 shares of this one, which is $1,337.25. Oh, you know what? Let me try to find, well, no, we can continue with the stocks for just a little bit longer. And then I will find a couple of bond, I think ETFs. We have a couple of. So, oh, what is this company? This is, oh, you know what? I think I want to diversify us into a chemical company. So it's Chemours company. The symbol is CC. And currently it's selling for $32.98 a share. So I just want to diversify us a little bit. This has been a very good stock for a while now. It's had a steady increase. And it has a buy-sell ratio of 4-0. So I think we definitely want to get in on this one. Again, I'm going to recommend 25 shares of this, which is $824.50. So just to give you an idea with everything we have right now, we have the information technology ETF, we have Spotify shares, we have, what is that? Wait, what did I just buy? Oh yeah, it was Alaska Airlines. Okay, I forgot to write that down. Okay, so we have quite a bit of technology, which is a little bit more of a volatile market, but you know, it generally produces pretty high returns, just given the speed at which our technology is improving these days. Then we have some travel stock and we have some chemical stock. The last stock here that I'm going to recommend, actually no, we have two more to diversify. One is Fox Corporation, which is a media company. I don't think it's related to the actual Fox News. I could be wrong. I thought I had looked that up at one point. But this one, Fox Corporation, maybe it is, it sounds like it is, but anyway, it was on my buy list a while ago, so I bought it. I don't know, I have to look it up whether it's actually related, but anyway. Currently, it is selling for $40.69 a share, so this will get us into the media sector. I'm going to recommend 25 shares, which is $1,017.25. Currently, we have, with everything on here, about $13,000 of investments. Just so that you know where we're at. And this is with the sum that you want to invest today. So not considering what we're going to do on a monthly basis. Okay, so the last one, and this one is my favorite, is Vidya. I don't know if I'm saying that correctly. It has a silent N. So this one is a very interesting stock because I think it's like a virtual reality or cryptocurrency mining company, but this one has blown up, and I think that this is going to be the Amazon of the next decade. So I would highly recommend getting into it because it is a lot of what they do is the future. So this one is currently selling at $242.30. And again, this is kind of a tech one, so we're getting a little bit. We have a lot of technology in this portfolio currently, but I'm still going to recommend 10 shares, which would give us $2,423 of Vidya shares. And the reason why is because I think that one's going to produce a very high return, and we're going to wish we would have bought more. But that can be one. Yeah, if you would like, we can continue to invest in that on a monthly basis as we're tracking how it's doing. But it has a very good outlook. Okay, so I think that's going to be it for the stocks. Now let me take a look at some of our bonds. Okay, so I have this core US aggregate bond ETF. Bonds are not really super hot right now just because of the low interest rates. However, I expect over the next year or two that they will start to take off as interest rates go up naturally. So this one is currently, so it's an ETF, so it's invested in multiple bond funds to diversify it a little bit, which is a little bit safer, but I'm going to recommend this. So 110.57 is the share price. And I think we're gonna just stick with these US bonds for now. I think as time goes on, we'll start to invest in some more foreign bonds. The US ones in this ETF are more safe, which means they don't have a very high return. So we are gonna wanna offset that and diversify it with a little bit more risky bonds. But we can hold off on that. So for now, to get us to the percentage that we want, let me see. We're gonna invest in about 45 shares of this for now. And with that starting portfolio of about $20,000, you're gonna be almost exactly invested 75% in stocks and 25% in bonds. So I think that is a great starting point for right now. And so moving forward, I have each month that you're going to be investing 10% into this portfolio. Okay, so that's perfect. So 10% of your income, just so that I make sure that I have that. After tax income. Okay, so we will develop more of an investment plan on a monthly basis. Obviously, it's going to change every single month just based on how the markets are doing. But just to make sure that I am aligned with your preferences. So just to clarify, you are good with the current percentage of the allocation for equity versus fixed income. Okay, and also one more question. Are you considering taking anything out of this portfolio over the next, let's just say 2 years? Or are you planning to just keep it all in here, and do you have another account where you're holding kind of your savings and cash? Okay, you have another account for your savings and cash, and you're not sure whether you might want to pull anything out of this. Okay, so maybe if you're not sure, I mean, is there a percentage that you might be comfortable with us leaving in more liquid cash investments, like maybe 25%. That's kind of a high percent. I would say maybe 5%. So 5% of what we currently have in here is, okay, that didn't work, is $1,000. But obviously as you contribute each month, that's gonna increase. So after a year, you'll have about, 2,000 of cash sitting in here. Okay, great. So that'll work. Yeah, I mean, I would recommend viewing this portfolio as kind of a long-term investment, based on what we have in here right now. But obviously, you know, if you need to take cash out, we can always sell things. And whether they're, you know, if it's a gain, then that's wonderful. If it's a loss, then it can offset some of your income for tax purposes. So even though you would have a loss, you would get the cash and be able to use that loss to offset your income and reduce your taxes. Okay, so I think that covers everything for today. Was there anything else on your mind? Anything else that I can help you with? Here is my card. Just want to make sure that I have you all set up with my contact information. You know, if anything comes up, feel free to call me, email me, anything at all, and we will get you set up to send you monthly reports of how your portfolio is doing. Okay? Okay, well, it was very nice to meet you. Have a great rest of your day.